wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This here is the Market Color Podcast, where we keep you informed on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 168. And in this episode, we're reviewing the performance of the global markets during the 28th week of 2025, and that is from Monday the 7th to Friday the 11th of July. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the global markets with a quick update on the ongoing U.S. tariff war, where on Wednesday, President Trump announced a 35% tariff on Canadian imports. This will be effective on the 1st of August after Canada retaliated against earlier tariffs by the United States. President Trump has also threatened higher tariffs across the board with a plan for a blanket tariff of between 15 to 20% on other trading partners. Whilst the U.S. tariffs continue to take center stage, trade tensions between China and the European Union are beginning to heat up. In recent weeks, the European Union and China have been going back and forth, criticizing each other over unfair trade practices. The European Union has imposed restrictions on Chinese companies taking part in public tenders for medical devices, and in retaliation, China has also imposed import barriers on medical devices from the European Union. In the United States, the minutes of the Federal Reserve's June policy meeting showed a growing divide amongst officials about how aggressively they would be willing to cut interest rates, driven by concerns over tariff-fueled inflation and signs of weakness in the labor market and a slowdown in economic growth. The minutes of the June policy meeting were released on Wednesday and showed that policymakers are largely held to a wait-and-see position on the future direction of interest rates. The June meeting ended with the Federal Open Market Committee members voting unanimously to hold the central bank's key borrowing rate within a range of between 4.25% to 4.5%, where it has been since December 2024. On Wall Street this past week, the stock market closed lower on Friday, a day after the S&P 500 posted a new record high, and President Trump announced a 35% tariff on Canada and threatened higher tariffs across the board. All the three major indices rose during Thursday's trading session but declined sharply on Friday, driven by an escalation in the ongoing tariff wars. Friday's losses pushed the three major averages into the red for the week, with the Dow Jones Industrial Average declining by about 1% to close at 44,371, whilst the S&P 500 slid by 0.3% to end at 6,259, and the tech-heavy Nasdaq Composite dipped by 0.1% to end the week at 20,000. $585. In related news, Tesla, the electric vehicle manufacturer, lost more than $68 billion in market capitalization on Monday as the stock fell nearly 7% after CEO Elon Musk announced plans to form a new political party. The billionaire's involvement in politics has been a major point of contention for shareholders. In the government bond market, U.S. Treasury yields ticked up higher on Friday as President Trump slapped a 35% tariff on Canada and threatened higher tariffs across the board as markets responded to escalating trade tensions. In addition to the 35% tariff on Canada, Trump said he was also planning a blanket tariff of between 15% to 20% on other trading partners, as well as a 50% tariff on imports from Brazil and another 50% tariff on copper imports. In response, the yield on the benchmark 10-year Treasury bond rose by 7 basis points to close at 4.417%, whilst the yield on the 2-year Treasury note was up by 2 basis points to end the week at 3.889%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the foreign exchange market, the dollar edged up across the board on Friday after President Trump imposed a 35% tariff on Canada and threatened higher tariffs across the board, sparking a flight to safety in the forex market. Following the announcement, the Canadian dollar initially fell by more than 0.5% before recovering to record a decline of 0.1%, with the exchange rate at 1.3668 Canadian dollars to the US dollar. Meanwhile, the euro was down by 0.1% at 1.1691 US dollars to the euro, and the Japanese yen declined by 0.8% versus the dollar to close at 147.40 yen to the dollar. Over the longer term, the US dollar is coming off its worst half-year performance since 1973 after it tumbled more than 10% against its global peers in the 6 months to June 2025. The US dollar faces a variety of headwinds heading into the second half of this year that could have far-reaching consequences for the global reserve currency. The main issue affecting the dollar is the country's rising budget deficits that continue to inflate the country's national debt, which is now approaching $37 trillion. In addition to that, the uncertainty created by the ongoing tariff war is likely to slow down economic growth and lead to higher prices and inflation as foreign investors seek an alternative safe haven currency. In the commodity markets, the price of crude oil rose more than 2% on Friday as investors weighed a tight market in the short term against a potential large surplus later this year, whilst U.S. tariffs and possible further sanctions on Russia remained in focus. On Friday, the International Energy Agency said that the global oil market may be tighter than it appears, supported by peak summer demand to meet travel and power generation requirements. Short-term demand notwithstanding, the agency has also boosted its forecast for supply growth later this year, whilst trimming its outlook for demand, implying a surplus and lower prices going forward. The price of the global benchmark Brent crude was on track for a weekly gain of 1.6% as it came to a close at $70.36 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this was up by around 0.6% and eventually settled at $68.45 per barrel. In the precious metals market, the price of gold rose by about 1% to a one-week high on Friday as investors rushed into safe haven assets after President Trump widened the global trade war with an announcement of new tariffs. Global stocks fell after Trump imposed a 35% tariff on Canadian imports and threatened a blanket tariff of between 15 to 20% on most other trading partners. The uncertainty premium is back in the market and is what is driving up the price of gold as investors shift into safe haven assets. In closing, the price of spot gold rose by 1.4% on Friday to finally settle at $3,372 per ounce. In the cryptocurrency market, Bitcoin extended its rally on Friday, rising to new record highs overnight after Bitcoin exchange-traded funds saw their biggest inflows so far this year. The rally began slowly on Wednesday following the release of the minutes of the Federal Reserve's last policy meeting, which showed a divergence of opinion amongst the officials. According to SoSoValue, Bitcoin exchange-traded funds recorded their biggest day of inflows this year on Thursday, with a record amount of about $1.18 billion. According to CoinMetrics, the price of the flagship cryptocurrency rose as high as $118,800 before correcting slightly for a daily increase of 4% and eventually settled at $117,900 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained unchanged versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24, which was the same rate that was recorded the previous week. Meanwhile, the sterling pound was priced at 175.87 and the euro was valued at 151.71. And on the regional front, one Kenya shilling was changing hands for 27.78 Ugandan shillings and 20.33 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.12. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $110 million for a grand total of $11.2 billion, which is equivalent to 4.9 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. On diaspora remittances, the inflow of remittances to Kenya totaled to $423 million in the month of June 2025, compared to $372 million in June 2024, which was an increase of 13.8%. In the meantime, the cumulative inflows for the 12 months to June 2025, this increased by about 12% to $5.08 billion, compared to $4.53 billion for a similar period in 2024. The steady growth in remittance inflows remains a key source of foreign exchange earnings and continues to support the country's current account position and provide stability to the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya and contributed about 53% of total remittances that were received in June 2025. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was stable at 9.61% compared to a rate of 9.67% the previous week, but was still pretty much in line with the central bank rate at 10%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 10.7 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on a Thursday, and the Central Bank of Kenya received bids totaling to 22.77 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 95%. The central bank ended up accepting almost the entire amount, taking in about 22.75 billion shillings, and the results of the auction were as follows. The 91-day rate was flat at 8.14%, whilst the 182-day rate took a slight dip to settle at 8.44%, and the 364-day rate ticked up by less than 1 basis point for an average weighted rate of 9.72%. In the primary bond market, the Central Bank of Kenya held its monthly bond auction on Wednesday, the 9th of July, and received bids totaling to 76.9 billion shillings against an advertised amount of 50 billion shillings, representing a performance rate of about 154%. The central bank ended up accepting about 66.6 billion shillings, and the results of the auction were as follows. For the first bond, which is a 20-year bond with 12.8 years left to maturity, the central bank accepted 30.5 billion shillings at a weighted average rate of 13.89% compared to the bond's coupon rate at 13.20%. The second bond, which is a 25-year bond with 18 years left to maturity, the central bank accepted 36 billion shillings at a weighted average rate of 14.34% compared to the bond's coupon rate at 13.40%. Up next is our topical issue. And this week, we are looking at Kenya's foreign debt repayments in the month of July. The government will spend about $531 million towards external debt repayments in the month of July 2025, decreasing the country's foreign exchange reserves, which currently stand at an all-time high of $11.20 billion. Despite this huge amount, the external debt repayment has actually declined from about $546 million that was paid out in July 2024, and this is mainly due to falling interest rates. In addition to that, a stable exchange rate for the dollar shilling over the past 1 year has helped to stabilize the cost of external debt repayments for the government. The months of January and July usually account for the largest external debt repayments due to the principal and interest payments for the $5 billion loan from China that was used to finance the construction of the standard gauge railway from Mombasa to Naivasha. The repayments for the standard gauge railway started in 2019 after a 5-year grace period. In the month of July 2025, the repayment towards the standard gauge railway accounted for about 81% of the country's total external debt repayments. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color Podcast, and I hope that you found it to be useful and informative. And if so, please share this with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color Podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, it's not so much about achieving your goals as it is about the person you become in the process of achieving your goals. Think about it. Thank you, and God bless.